Okay, good morning. Today I thought what I would do is actually answer some questions and answers. This is going to be something I'm going to test, and there's a couple reasons for it. Number one, I'm getting more and more emails from people that are looking for help on how to invest in commercial real estate, which is great. And the constraint or challenge that I have is, with every new deal that comes into my world, and obviously even just trying to grow a construction company right now, there is only so much time that I have. And so really what I'm doing is I'm essentially looking at doing more question and answer for the podcast for Facebook. So if you have questions, go to my website. You can submit them on the contact form. Maybe I'll come up with something a little bit more creative and professional in the future, but that's the idea. And the goal hopefully is to be able to still offer and provide this information and insights, because one thing I've noticed is the questions, even though they might be nuanced, they come down to a few of the basics. And so to spend 20 minutes with someone in a one-on-one conversation, frankly, it's not a very good use of my time, because I can only have so many of those. So if I only have one or two conversations a week, but I get 20 emails, then 18 people, unfortunately, don't get a chance to have their question answered. So I thought what I would do is actually just start answering questions here, and hopefully that will, if there's 500 people that listen, maybe 10% will actually have their question answered, or at least even provide some insights. So none of this is meant to be hard and fast rules. This is not. These are just my opinions, okay? And you can disagree with them, and that's totally fine. I just want to give you how I think about investing, and you can decide for yourself whether or not it works for you, okay? So with that said, here are some of the questions that I received last week. This is from two specific people that asked questions. I'm going to protect people's names, but I do want to use real names, so I don't have to keep referring to person or what have you. So let's just say the first person is Tom. Okay, so Tom asked, okay, here, where is it? Okay, I'm going to paraphrase this one. So, Shane, I have a property that I want to raise money for. Question one, how do I raise money from multiple investors? So, this is fairly simple. My book goes into this in great detail, Club Syndication. Now, the way that I do syndications, the way other people do syndications are a little bit different. But essentially, Club Syndication is like a very tight-knit group of people that you are raising capital from. They would be accredited high net worth investors. And, by its definition, if you will, or by the as the name implies, Club Syndication is, it's a smaller group, if you will, versus what I'm seeing a lot of investors in, especially the US, where they're going out to a very mass audience and they really don't have that kind of connection or relationship. There's no one way, right or wrong. I'm just telling you how I raise capital. Okay. So it's a GPLP, general partner, limited partner. That is different than a joint venture. I've never done a joint venture. Well, I shouldn't say I've never. I suppose I did joint ventures when I was doing residential real estate back in 2003 or 2004 with friends. But I just find that LPGPs work a lot better, especially when you're doing, 5, 10, 15 investors. Okay. I'll typically offer a preferred return. I will get fees for usually putting the deal together, and then I'll get a percentage on the back end. Okay, so if you want more details, literally you can go to my website, download the book for free, or you can buy it. It's up to you, and you can get some bonuses. Okay, question two. I have two sets of investors, one who want to actually own the units of the project, and the other who want something else. Essentially, they just want the returns from the investment. So this question, once I kind of dug into it a little bit, what I discovered was this gentleman, Tom, had a couple of different options that he was considering. And really what I concluded in that conversation was a lack of clarity. And this is not uncommon. It's usually why having someone on the outside ask you tough questions can be a good way to help you get that clarity. All right. And so in this case, the answer will hopefully, you don't even really need to understand the question behind it, because you'll get the answer here, if you will. And that is, I don't do deals. Just so you know, I'm looking off screen just to look at my notes here. I don't do deals to try to appease all of my limited partners, right? Because I have partners that are 30 up to probably 65, and some that have 9 figures, and some that are probably 7 figures, if you will, in terms of net worth. And so age, what occupation, what they are most interested in, value add, development, cash flow, like trying to make everybody happy and trying to go out and source opportunities that I think would make someone want to invest with me, I think would frustrate the process. And I think there's a saying, like, when you try to make everyone happy, you make no one happy. And so my suggestion was, have a clear plan. People are looking to you, especially if you're raising capital, that you know what you're doing and that you have focus and clarity on what it is that you're after. That to me is probably more important. Like, the theme or the through line is, okay, this is what we're doing. If this doesn't work, then we can fall back to plan B, if you will. But to try and just make everybody happy and, well, I'll do this for you and I'll do this over here for the other person, and hopefully I said, frankly, what will happen is you'll piss everybody off, because this whole concept of being fair, everyone, in my experience, has a different idea of what fair is. And I don't even really like that terminology, because my own personal belief is life isn't fair. Okay. And you can kind of see that pretty clearly in just the society and whatnot. So the idea is, like, have a plan, something that works for you, that is that you believe in, and that you can look someone in the eye and say, this is what we're doing. This is why I believe that the opportunity will work, and hopefully it will work for you. And if not, that's okay, right? Not everybody comes into every one of my deals, because they sometimes change. All right. That was the first set of questions. Now the second set of questions, these are a little more technical in nature, if you will. So question, what is the total ROI on a value add project your clients achieve, and how much of our initial capital should we expect to pull out after we refi? Okay. So this question, it's a good question. I understand where the person was coming from, but the reality is there's no one way to answer this, because real estate and commercial deals are, every deal is different. And so what I thought I would do is I'll give you kind of an example. Now, when I do development deals, for sure, I'm looking at pulling out the majority of the equity that goes into the deal, right? So on this retail property that we're now in the process of refinancing, we should expect about 60% of the initial equity out. And the reason for that is it took a little longer, COVID, blah, blah, blah. I'm not going to make excuses. The reality is that it took longer than we expected. Okay. And we had to change some of the plans. So now let's just use an example here of an industrial property, right? And this isn't far-fetched. These are deals that I see, I don't want to say frequently, because it takes some time and energy to find value add opportunities, especially deals that you want to invest in. But let's just use this as an example, because the numbers are pretty simple and I can just kind of rattle them off. Okay, so you have an industrial property, 10,000 square feet, one bay vacant. Let's say the bay is 2,000 square feet. Okay, the rent is $10 a square foot. You're going to buy the property at a 5 cap, which essentially means if you bought the property all cash, you would get a 5% return on your money. Okay, so the NOI, the net operating income on this property, 8,000 square feet, that's what's leased, times $10 a foot, that's $80,000 of NOI. Okay, now at a 5 cap, what that essentially means is, and you guys can run the math if some of this is off, but I literally just did it at Starbucks this morning without a calculator. But a 5 cap would be 1.6 million, right? You just take that 80,000, you divide it by 0.05, 1.6 million. Now, when you fill the vacancy, right? So you bought it at 1.6 million, You're going to put 25% equity down, which I believe is around 400,000. So we're buying an industrial property. It's got 20% vacancy. You paid 1.6 million for it, right? You put 25% down, which would be 400,000. You fill that vacancy now, right? Now that you've purchased the property, which means you're going to have $10 a square foot. That's the rent. 2,000 square feet, $20,000 of new net operating income. Okay. You take that 20,000, you divide it by 0.05. That's $400,000 of value that you've created, which now means you have doubled your equity. Now, why do I do that? Because there's lots of variables here. First of all, you're going to have downtime. You're going to have leasing commissions. You're going to have potential TIs. You're going to have free rent. So it's not like you just fill this space and you net 400,000. But what I'm not talking about is some of the more it's not that complex. It's basically slippage or the fact that you're no longer losing the op costs. But I want to keep this example very high level. Okay, when I work with people, we get into the details, if you will. But this is what I call a back of the envelope. Okay, so that is essentially how you could potentially get into a value add opportunity and double your equity. Okay, so that's just very straightforward and works. Those examples with retail, industrial, you could do office. I'm not a big fan of office, mainly just because I don't understand the tenants as well. But that's certainly something you could do. All right. Next question here is it realistic to expect deals can be structured where I can pay my partners out and keep the property? So this is kind of an interesting question. And what I would say, this is just my own personal belief system and philosophy, if you will. And that is when my investors take a chance on me on the start, they get to stay with me through the deal, meaning that just because I can refinance them out and pay them out doesn't necessarily, like if they want to stay in the deal, then they have that opportunity and ability. And let's face it, at the front end of a deal is where there is more risk, if you will, versus later on once the deal has been stabilized and the value has been created. Now, some people, investors, they just want to get in and out of deals. And so if that's the case, certainly. But I just wanted to kind of share that. Now, next question here is, with the development training and your support, can I go out and put a team together to do a project? Now, this individual was looking at doing developments. And I will just say that even though I've been in the business of investing in commercial real estate, and I started, I think in 2005, 2006 on the finance side at Sun Life, the reality is developments are like in the spectrum of complexity. Development and basically like taking raw land and rezoning it are like a level 9 and 10. And so if you've never invested in commercial real estate and you want to start doing developments, I feel that is going to be, oh, hey, Ollie, good to see you, buddy. My little puppy just came in. Come here. You can say hi. Okay, you go. I'll be right upstairs, buddy. I would just say that as it relates to if you're considering doing development, and even for myself, I would certainly find someone that has a track record that you trust, that will take you under their wing. I mean, that's how I got into it, and that's how I still do my development deals today. So I would say that those are two important attributes. Now, the question will become, what value can you bring to the table, right? And so, frankly, the value that I suggested to this individual looking at getting into developments was you could find the land, or you could bring the money, or you could do both. So those would be the two ways that you could essentially add value. Next question. I'm considering investing in the U.S. So this is a Canadian that wants to invest in the U.S. for my first commercial property. What are your thoughts on long distance investing? And I have pretty strong opinions on this. And here's the reality. I talk about this frequently, and that is commercial real estate is a relationship driven business, which to me means the closer to home you invest, the more likely that you have good relationships, right? You can go look at a property, you can take people for lunch, you understand the market. I said, so if you've never invested in commercial real estate, you're going into a new market. The reality is, especially when you understand the world of commercial real estate, brokers are going to, like, they want the path of least resistance, not in a bad way, but they want deal certainty. And so if you've never invested, meaning you don't have a track record, you're out of state or out of the country, you're just stacking on more challenges to getting your first deal done. And I know that the term, like, the grass is always greener. I've fallen for it myself. I've went down to the US and I've invested, and you can certainly do that and make money, but I would not do it kind of on a whim. Like, I think if you're going to go into the US, you really want to go down there in a very disciplined fashion. You understand, you study the market, and you just commit that this could take me 2 years, but I believe in Sarasota, Phoenix, whatever the market is. I'm going to meet 5 brokers. I'm going to get to know them. It might take me 6 months before I even start looking at real properties, but this is really where I want to put my money. Sure, that's understandable. And I'm going to get on a plane. If I see a property that makes sense, then I'm going to get on a plane and get down there. And I told this gentleman when I was speaking to him, I'm just going to leave it at this because I think that I've got to get going here. One of the biggest challenges for new investors getting into commercial real estate is they have a hard time identifying a good property from just an average property or a crap property. And I remember having a conversation with these 2 gentlemen out of Minneapolis, very nice guys. They had been residential investors for quite some time. And they showed me, I asked them about a deal that they had seen because I wanted to know kind of where on the journey they were. And they had described a property that they found off market, and they basically gave this the seller kind of like a lowball offer, in my opinion, right? I didn't know the market, but just based on the price per square foot and what the value of it was in the past, I felt like they were really trying to, give like steal the property, right? And look, there's no judgment here. It is what it is. But I just said, okay, well, what ended up happening? And they didn't really want to say. And I said, well, let me tell you what I think happened. You submitted an offer, and the seller took your offer, shopped it, found another buyer that came in, paid $1 million more, and they sold it to that person. And they said, yeah, it was actually 1.2 million more. I said, yeah. So I said, yes, and they didn't think that they could make money at that price. And I said, well, how did you come up with that conclusion? What's the value? What's the end value, right? So property today, property in the future, and there was almost $4 million of value in this property. And if it took $1.5 million or $1 million to get to there was still a lot of juice in this deal. And I said, I don't even think that was the highest and best use. I bet the investor that bought that property had a very different vision for what they were going to do with it. And so why am I telling you this story? Really what I want to get across is just the concept of, like, understanding the market that you're investing in so well that when you see an opportunity, you take advantage of it as quickly as possible, because there's people out there that have been in the business, and without even knowing the property, but just what they had described, I said, like, I would be all over that, right? 40% vacant, great hard corner location, ability to do mixed use, excess land. I could tell there was excess land just based on, it was 4 acres on how much the density that they had on it. And so the more I think that you can educate yourself, the more that you look at properties, the better positioned you will be to take advantage and really get into the game. So that's what I got. I got to go see my puppy and then work out. And yeah, like I said, if you have any questions, you can drop them under Facebook here. You can go on my website, or if you're seeing this on YouTube down the road, by all means, ask your question. Be as specific as possible. You don't have to talk about specific properties. That's because obviously in commercial real estate, you want to keep that confidential. And I don't need the property. That's not important. Really, what I want to get across are just some themes and principles and investing philosophies that hopefully will help. So if that works, by all means, you can submit them. And if I think it'll benefit other people, I will answer it live. Okay, bye for now.